You've likely watched it happen over the last few months. You buy the dip on your favorite altcoin, anticipating the inevitable alt season, only to watch your portfolio bleed out on another fracturing fakeout. This chart compares an aggregate altcoin index against the S&P 500. While your altcoins are setting lower lows, traditional equities are actively hitting all-time highs. The retail market is getting crushed right now because they are trading off outdated, highly subjective data. To understand what is actually happening, we need to look at the exact volume gap institutional whales are using to target $84,000 and the macroeconomic mechanism that proves why altcoins are currently broken. Welcome to Crypto Whale Radar. Surviving this cycle requires abandoning retail patterns and aligning your portfolio strictly with institutional order flow. This is a standard 30-minute Bitcoin chart, overlaid with a symmetrical triangle. This is exactly the kind of diagonal pattern retail traders are obsessing over right now. Drawing lines to connect lower highs and higher lows assumes the market respects geometric shapes over actual capital flow. In the current environment, trading a breakout from this structure is a coin flip that provides liquidity for larger players. Replace diagonals with a fixed range volume profile and a volume-weighted average price trend line. The VRVP maps actual trading activity. Measuring this recent range, the value area low and heaviest institutional buying support is firmly anchored at $66,000. Looking upward, the value area high sits at approximately $78,000. Price compresses directly against this VWAP trend line. Notice the critical anomaly on the right axis. A severe lack of trading volume sits directly between $78,000 and $84,000. Markets move quickly through areas of low liquidity. Once the resistance at $78,000 breaks, the price will violently vacuum upward to find the next node of heavy demand at $84,000. Retail traders waiting for a standard retest will be left entirely behind. That specific volume vacuum aligns perfectly with the current positioning of over-leveraged short sellers. This heat map displays the 3-day Bitcoin liquidation levels, revealing exactly where institutional whales are hunting for forced buying. Over $100 million in short liquidations are concentrated right here, sitting perfectly inside our volume vacuum between $80,000 and $84,000. Whales will intentionally drive the price into this zone to trigger those liquidations. When shorts are liquidated, they are forced to buy back their positions at market price, which fuels an explosive, self-sustaining squeeze straight to $84,000. Capturing a high volatility breakout through a liquidity vacuum requires a platform with a flawless matching engine. That is why I trade exclusively on BingX. During these violent institutional moves, its reliability prevents the exact type of slippage that destroys retail margins. Use the specific link in the description below to secure platform bonuses and get direct access to my trading guidance. We know the short-term target is $84,000. To see if this move has longevity, we must evaluate how it aligns with the macroeconomic cycle. Profitable trading is about identifying where whales intend to trigger liquidations and positioning yourself on a reliable exchange to capture the ensuing squeeze. Mastering this level of institutional data separates the profitable minority from the traders who serve as exit liquidity. Make sure you subscribe to the channel to keep receiving this analysis. Now, let's step away from the 30-minute charts and evaluate the macro weekly timeframe. The underlying engine driving macro price action is the expanding M2 money supply. With fiat currency devaluing at roughly 8% annually, traditional valuation metrics warp. This chart tracks the steady rise of the M2 money supply, alongside the multi-decade trajectory of the S&P 500 and the aggressive exponential growth curve of Bitcoin. Adjusted for inflation, the S&P 500's real growth is slow. Bitcoin acts as a highly sensitive, math-driven hedge against that exact monetary expansion, violently outpacing equities. This era of perpetual debt and rapid money printing accelerated dramatically after standard financial anchors were abandoned in 1971. As long as the underlying fiat currency continues to be printed to service national debt, asset prices must mechanically rise to absorb that excess capital. Bitcoin's ultimate trajectory is driven directly by its design as an escape hatch from an inflationary financial system. This brings us back to the brutal reality of opportunity cost if you are still holding on to stagnant altcoins. This chart tracks the Total 3 index, which represents the crypto market excluding Bitcoin and Ethereum, priced against gold, silver, and the Nasdaq. The altcoin market has been actively bleeding valuation against all three traditional assets for years. This persistent weakness is a direct result of restrictive central banking policy. The Fed funds rate currently sits at 3.75%, which aligns closely with the 2-year yield, effectively the market's neutral rate. Macroeconomic policy remains firmly restrictive. Altcoins are effectively the penny stocks of the digital age. They require highly loose monetary policy and near-zero interest rates to generate the excess liquidity needed for sustained rallies. Holding high-risk altcoins during a period of restrictive interest rates is a mathematical miscalculation that slowly bleeds retail wealth into foundational assets like Bitcoin and gold. Yet an illusion keeps retail traders heavily exposed to altcoins. They look at Bitcoin dominance and assume it has plateaued at 60%. This standard Bitcoin dominance chart includes all cryptocurrencies, showing the metric moving sideways and reinforcing the false hope of an incoming alt season. But if we apply a basic filter and subtract the bloated market caps of stablecoins like Tether and USDC, the math changes instantly. The adjusted Bitcoin dominance is actually in a steep uptrend, establishing a new peak near 68%. The rule for navigating the rest of this cycle is straightforward. Protect your capital by escaping the altcoin opportunity cost trap. Prepare for the imminent break of $78,000 resistance and the ensuing vacuum run to $84,000. Click the video on your screen right now to learn exactly where to place your stop loss to survive the incoming volatility. Trading off geometric shapes and ignoring macro volume data ensures you remain exit liquidity. Trading the vacuum is how you become a whale.